Hi, welcome to iEducator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 6. And Chapter 6 is all about cost terms and concepts. Now, in this lesson, there are 7 key areas that I'm going to be discussing today. First, we have the introduction. Second, we have cost determination and reporting methods. Third, we have cost accounting approaches. Next, we have cost classification in relation to products. We also have cost classification for external reporting purposes and cost classification for predicting cost behavior. And finally, we have cost classification for decision making. Now, studying managerial accounting requires knowledge on the various terminologies that are commonly used by business practitioners and academicians. As part of learning more about managerial accounting, knowing the definition of these various terms and its applications will make this subject understandable from viewpoint of the learner. The authors believe that communication can be clearer and actions can be effective if we know the basic terminologies in management accounting. Now, the basic terminologies in management accounting, first we have cost. If we say cost, this refers to the money or resources sacrificed, foregone, or paid by a business enterprise to achieve a specific objective. For example, a company purchased a computer for 50,000 pesos. This is the cost that would be recorded in a company, okay? Because it is the money or resource foregone or sacrifice. And this cost is what we called historical cost. And as such, it must be covered with the evidence or receipts in order to be objective. Remember your objectivity principle? It is the principle that requires business organization to support its transactions with evidence. And this principle is also called as reliability principle or verifiability principle. Another basic terminology, we have cost objective. If we say cost objective, this refers to the cost of anything which is to be measured. A cost objective is any item such as a product, department, customer, or a project for which the cost is determined and assigned. For example, if one wants to measure the cost of sales department, then the cost objective is the sales department. Another example would be if one wants to measure the cost of product X, then the cost objective is product X. And lastly, if one wants to measure the cost of project Z, then the cost objective is project Z. Now, the reason why one assigned a cost object is simply to measure the cost of such thing. And measuring the cost is very important in decision making. If one decides to improve its cost, then the records can be relied upon in making the decision. Another basic terminology in management accounting, we have cost accumulation. And cost accumulation refers to the accumulation of cost information that will be done in a systematized manner using an accounting system. For example, if one accumulates cost using job order system, then the cost accumulation will be done on a per job basis, okay? Another example would be if one accumulates cost using process cost system, then the cost accumulation will be done on a per department basis. Another basic terminology is what we call cost assignment. First, this involves the assignment of direct cost to cost object, which is called tracing. And tracing can either be direct tracing and driver tracing. Now, what's the difference between the two? If we say direct tracing, it is the process of identifying and assigning costs to a cost object that can be specifically or physically associated with the cost object. It can be accomplished by physical observation. For example, direct materials and direct labor are used to make a product, right? Both are physically observable, and therefore, the cost of direct materials and direct labor can be directly charged to the product. It can be directly traced to the product. On the other hand, if we say driver tracing, the use of drivers to assign costs to the cost object, and this can either be resource drivers or activity drivers. And lastly, cost assignments involves assigning indirect cost to cost object that is referred to as cost allocation. This is also the term used for the assignment of various overhead costs. For example, electricity charges, insurance and property charges, or taxes rather, or salaries of the supervisors to various jobs that is to be done in the factory shall be allocated using cost allocation. Okay, this is all about cost assignment. Another basic terminology that we have is cost accounting. If we say cost accounting, it is the calculation of cost of a product or service for planning, directing, and controlling the activities of the business enterprise, therefore improving its product, service, quality, and efficiency. In simple terms, cost accounting is a facet of management accounting that determines the actual cost associated with manufacturing a product or providing a service by looking at all expenses with the supply chain. Examples include rent, depreciation, interest on loans, and lease expenses. All right, so these are just a few of the many examples of cost accounting. Another terminology that we have is what we call cost accounting system. If we say cost accounting system, it is the means by which accounting information is processed and reported. A typical cost accounting system usually works by tracking raw materials as they go through the production stages and slowly turn into finished goods in real time. Now, when the raw materials are put into production, the system immediately records the use of the materials by crediting the raw materials account and debiting the goods in process account. Now, since most products go through many stages before they can be called finished goods, there are often several different work in process accounts. For example, as the materials move from one operation to the next, the cost accounting tracks the progress and updates it in the computerized system. This is extremely helpful for production managers and cost accountants, so they can see how much inventory is in every stage of production at any point in time. It also allows companies to maintain just-in-time inventory systems where materials are only ordered from vendors and suppliers on an as-needed basis. No extra quantities are ordered and stored for processing at later points. Now, the company only orders enough materials to fulfill the current customer's orders, and this saves the company on many different costs, including storage, security, and obsolescence. And next, we have cost pools. And according to the author of our book, cost pools is defined as categories into which overhead is divided for the purpose of calculating multiple overhead rates. Now, what do we mean by this? If we say cost pool, it is a grouping of individual costs typically by department or service center. Cost allocations are then made from the cost pool. For example, the cost of the maintenance department is accumulated in a cost pool and then allocated to those departments using its services. And the next key area that I'm going to be highlighting right now, that would be cost determination and reporting models. Now, under cost determination and reporting models, this is comprised of 5 types. First, we have actual costing. Second, we have normal costing. Third, we have standard costing. Fourth, we have variable costing. And finally, we have absorption or full costing. Now, in order for us to better understand each of these types, let us discuss first actual costing. So if we say actual costing, it is a valuation method that uses actual direct materials, direct labor, and overhead changes in determining the product cost. Now, actual costing is a cost accounting system which uses actual costs, direct cost rates, and actual quantities used in production to determine cost of specific products. Usually, an accounting costing system traces direct cost to a cost object or something that has a measurable cost. In other words, managers go back to the source of the cost or cost objects like labor and materials. Managers can analyze how many hours of manufacturing time a product requires to calculate the actual costs of producing that product. Now, the formula in getting actual costing, so we have two. We have actual direct costs, and the formula that would be equal to actual cost rates multiplied by actual quantities used. And we also have actual indirect costs, which is equal to the product of actual cost rates and actual quantities used. For example, managers can use these formulas to calculate the total production cost. For instance, managers first need to find out how many hours it took the company to produce the product and how much the company is paying its employees per hour. Using the first actual costing formula, these numbers make up the labor portion of the production cost. The same is done for materials. Overhead is a little different. Since overhead, like utility usage, is a little difficult to assign to a single product, managers usually make estimates. They estimate how much overhead was used and how long the overhead was used. Using the second actual costing formula, management can determine the indirect production costs for producing the product. After all the calculations are done, add up the totals and you will get the actual cost of producing your product. And after the actual cost is known, then management can change the production process in order to meet budget goals. So this is all about actual costing. Next, we have normal costing. If we say normal costing, this is a valuation method that uses actual cost of direct materials and direct labor in conjunction with a predetermined overhead rates in determining the product cost. In simple terms, if we say normal costing, it is a cost allocation method that assigns costs to products based on the materials, labor, and overhead used to produce them. In other words, it's a way to find the price of an item that is being produced using 3 different cost factors, which make up the product cost. Now, the product costs that make up the normal costing are actual materials, actual direct costs, and manufacturing overhead. The materials and direct costs are the true costs that are associated with producing the item, such as raw materials or the materials that make up the product, and also we have labor. And in this costing approach, manufacturing overhead is an estimated rate decided by the management or accountants. Manufacturing overhead includes the expenses that are related to producing the item but cannot directly be applied to the items. Examples of manufacturing overhead include facility rent or mortgage, electricity in the facility, and depreciation on the machines that are used to produce the items. Example, Terry is the CEO of a furniture manufacturing company, and Terry needs to find the normal cost of one of their most popular item, a coffee table. Now, in the last production, the company produced 10,000 coffee tables. The actual materials used totaled to be $50 per table, and direct costs were $20 per table. Now, the manufacturing overhead determined per table is $10. So, Terry determines it costs the company $80 to produce one coffee table. Terry can use this information in many different ways. One is to value his inventory. Any company that has inventory has to assess its value for accounting purposes. And this costing method is a popular way of valuating inventory because it associates two actual costs, materials and direct costs, and only one estimated rate to the product. Terry can also use the normal cost per unit to determine a markup for sales. Now, if Terry makes each coffee table for $80 and wants to mark up all items at 100% rate, he would sell the coffee table for $160. Now, in summary, if we say normal costing, it means a way to determine the cost of a manufactured item using the product cost. Aside from normal costing, we also have what we call standard costing. And standard costing is a valuation method that uses predetermined norms for direct materials, direct labor, and overhead for assigning costs to the various inventory accounts and cost of goods sold. Now, in simple terms, if we say standard cost, it is an estimated expense that normally occurs during the production of a product or performance of a service. In other words, this is theoretically the amount of money a company will have to spend to produce a product or perform a service under normal conditions. Now, standard costs are sometimes referred to as preset costs. Again, this is sometimes referred to as preset costs because they are estimated based on statistics and management's experience. Basically, management calculates how much each step in the production process should cost based on the market value of goods, median wages paid per employee, and average utility rates. This estimated calculated amount is the standard cost. It's the amount that the company should have to pay to produce a good. Now, in order for us to better understand standard costing, let us have an example. Okay, for example, management uses these costs in two different ways. First, they use them to plan out future production processes and increase efficiencies. By looking at the present costs for operations, management can innovate new ways of producing products that don't require the same procedures, thus reducing costs. Second, management uses these expenses to determine how reasonable the actual costs were for the period. Since present costs and actual costs are rarely identical, management can evaluate how close the actual expenses matched what they should have been. This is similar to the budgeting process. If the actual expenses were higher than the preset expenses, then the company would have an unfavorable variance. On the other hand, if actual is less than the standard, the difference is said to be a favorable variance. Management can use these variances twofold: evaluate the efficiencies and inefficiencies that led to the variances and adjust them. It can also evaluate the expenses for fraud. For example, if actual material were way above the standard limit, management can investigate why so many raw materials were purchased and whether or not all of the purchases were put into production. This ensures employees are not ordering goods and stealing them. Typically, standard costs are divided into three categories. We have material, labor, and overhead. Okay, aside from standard costing, we also have what we call variable costing. If we say variable costing, it is a cost accumulation and reporting method that includes only variable production costs, or we have direct materials, direct labor, and variable overhead as inventoriable or product costs. This is not acceptable for external reporting. Now, in simple terms, if we say variable costs, these are production costs that change in proportion to the amount of goods that are produced. In other words, for every good that is produced, variable costs increase by the same amount. In any production process, manufacturers incur variety of costs. Cost accountants and managers usually split these costs into two main categories. First, we have variable costs, and second, we have fixed costs. Now, in order for us to better understand this, let us have an example. For example, a good example of variable costs for a piano manufacturer is the cost of piano keys. Every piano that is produced has to have a set of piano keys that costs $250. This means that every time a piano is produced, variable costs go up $250 because an additional set of piano keys must be purchased. If 100 pianos were produced, the piano keys variable cost would be $25,000. If only 10 pianos were produced, then the piano keys variable cost would only be $2,500. And the total variable costs fluctuate with the amount of pianos that are produced. Now, fixed costs, on the other hand, do not fluctuate with the production levels. Fixed costs are always the same. A good example of a fixed cost is rent. It doesn't matter whether the piano manufacturer makes 10 pianos or 100 pianos, the rent expense will always be the same, okay? So another type of cost determination and reporting models, we have absorption or full costing. If we say absorption or full costing, it is a cost accumulation and reporting method that treats the cost of all manufacturing components, direct materials, direct labor, and variable and fixed overhead as inventoriable or product cost. This is a traditional approach of product costing, which is used for external reporting. All right, so the next key area that I'm going to be discussing right now, that would be cost accounting approaches. And there are four types under cost accounting approaches. First, we have job order costing. Second, we have process costing. Third, we have standard costing. And finally, we have backflash costing. If we say job order costing, it is a system of accumulating costs that focuses on a specified product and is based on customer specification or job order. We refer to these products as heterogeneous products. When we say heterogeneous products, these are products depending on the specification of the project. Examples of job order costing would be furniture manufacturing, we have cosmetic manufacturing, and we also have printing company. And another type of cost accounting approaches, that would be process costing. If we say process costing, it is a system of cost accumulation that is applicable for producing large quantities of homogeneous products. The cost is accumulated by department rather than by job order. Examples of industries using process costing, that would be cement manufacturing, textile, steel, and we also have soft drink manufacturing. And another type of cost accounting approaches, we have standard costing. If we say standard costing, system of cost accumulation where a product norm cost is already established before its manufacturing process. What do we mean about this one? Norm cost means that before producing a certain product, the company already has the total recognized cost. The actual cost of producing the product will be analyzed in what is referred to in accounting as variance analysis. So what is meant by variance analysis then? If we say variance analysis, it is a system used by accountants whereby the variance or the difference between the standard cost and the actual cost will be analyzed. Variance analysis can be made on direct materials, direct labor, and factory overhead. Standard costing can be applied to either job order costing or process costing. And this will be discussed in chapter 13 of our textbook. And finally, the last type of cost accounting approaches, that would be backflash costing. If we say backflash costing, it is a way to accumulate costs in a factory or part of a factory where processing speeds are extremely fast. It bypasses the routine cost accounting entries that are required in subsidiary records for job order and process cost accumulation. This means that backflashing can be used in job order or process costing. All right, so the next key area that we're gonna be highlighting right now, that would be cost classifications in relation to manufacturing, in relation to products. Now, there are four types of cost classifications in relation to a product. First, we have manufacturing cost. Second, we have direct materials. Third, we have direct labor. And finally, we have manufacturing overhead. Now, in order for us to better understand each of them, let us discuss them one by one, starting with manufacturing cost. If we say manufacturing cost, this cost refers to the direct materials, direct labor, and manufacturing overhead. So this is the total cost of the product, and therefore the formula in getting manufacturing cost, that would be manufacturing cost equals direct materials plus direct labor plus manufacturing overhead. On the other hand, if we say direct materials, these are the raw materials used that form an integral part of the product and are directly and conveniently traced into it. What I mean about this is that if we say direct materials, these are the materials that are directly related in the manufacture of a certain product. And next we have direct labor. If we say direct labor, it is the payroll cost of employees directly doing the job and can be easily traced into the product. So what do we mean about this is that if we say direct labor, these are the labor or the employees who are directly involved in the manufacture of a certain product. And finally, we have manufacturing overhead. If we say manufacturing overhead, it is the cost incurred that is related to the product but not part of the direct materials and direct labor. So these costs are usually assigned to a product for job order costing or to a department for process costing. And it is sometimes called as factory overhead, factory burden, or indirect manufacturing overhead. All right? So examples of manufacturing overhead, for indirect materials, we have factory supplies. We also have lubricants. And under indirect labor, we have supervision, inspection, salaries of factory clerks, and defective works. And for other indirect costs, we have insurance, property tax, we have utilities such as water bills, electric bills, telephone bills, etc. All right. So next we have prime cost. What do we mean by prime cost? If we say prime cost, it refers to direct materials and direct labor. So in getting prime cost, the formula that would be the sum of direct materials and direct labor. So in order for us to better understand prime cost, let us have an example. Okay, for example, Mandawi Foam manufactures 10 bed frames and incurs 250,000 pesos for lumber, 75,000 pesos for hardware, and 50 hours of labor for product assembly at a rate of 50.50 pesos per hour. So letter A, we need to calculate the prime cost. Remember, the formula in getting the prime cost, that would be the sum of the direct materials and direct labor. And letter B, we are tasked to get the amount as to how much must the company sell for each bed frame to generate a profit. So first, let us calculate first the prime cost. So based on our problem, the cost of our lumber, that would be 250,000 pesos, plus the cost of our hardware, that would be 75,000 pesos. So the total cost of our raw materials or direct materials, that would be 325,000 pesos. On the other hand, in getting the total cost of labor, we need to multiply the total hours rendered to the hours per rate. So again, the labor in this case, based on our problem, rendered 50 hours. And the rate per hour, that would be 50 pesos and 50 cents. So therefore, the total cost of our labor, that would be 2,525. Now, in getting our prime cost, all we need to do is to add the total cost of our raw materials or direct materials and the total cost of labor. So our prime cost in this case, that would be a total of 327,525 pesos. Now, for letter B, how much must the company sell for each bed frame to generate a profit? Now, in getting the prime cost of a single bed frame, we simply need to divide our prime cost to the total number of bed frames that we are producing. So in this case, our prime cost is 327,525 pesos divided by 10. So therefore, our prime cost of a single bed frame, that would be 32,752 and 50 cents. So therefore, Mandawi Foam must sell each bed frame for more than 32,752 and 50 cents to generate a profit. Okay, so this is all about prime cost. Next, we have conversion cost. What do we mean by conversion cost? If we say conversion cost, this cost refers to the direct labor and manufacturing overhead. And therefore, the formula in getting conversion cost, that would be the sum of direct labor and manufacturing overhead. So in order for us to better understand conversion cost, let us have an example. Okay, for example, Mandawi Foam manufactures bed frames with the following information. Completed units, we have a total of 50,000 pieces, finished goods, completed goods. Another information we have, that would be direct wages amounting to 1,900,000 pieces. Next, we have indirect wages amounting to 250,000 pieces. Next, we have direct materials, which is amounting to 1,450,000 pieces. Next, we have indirect materials amounting to 50,000 pieces. We also have equipment depreciation, 325,000 pieces. Next, we have office expenses amounting to 500,000 pieces, which is 500,000. And finally, we have factory insurance amounting to 100,000 pieces. Remember that the formula in getting our conversion cost, all we need to take into account are the direct labor, again, direct labor and manufacturing overhead costs. Now, the first thing that we need to do in order to solve this problem is to determine our direct labor for based on the given information. So, okay. So in determining the direct labor, so our direct labor would be the direct wages amounting to 1,900,000 pesos. Okay, so that's the only direct labor that we have. Now, another thing that we need to take into account is the manufacturing overhead cost. Now, since we already have identified our direct labor, it is now time for us to determine our manufacturing overhead. So, okay, so the first manufacturing overhead that we have, that would be indirect wages, amounting to 250,000 pesos. Aside from indirect wages, we also have indirect materials, 50,000 pesos. And aside from indirect materials, we have equipment depreciation. This is still under manufacturing overhead, amounting to 325,000 pesos. And finally, we have factory insurance, amounting to 100,000 pesos. So the next thing that we need to do is to simply get the sum of these manufacturing overheads that we have. And in getting the sum, we have a total of 725,000 pesos for our manufacturing overhead. And since we already have the value of our direct labor and manufacturing overheads, all we need to do next is to get the sum of each. And so we will be able to calculate our conversion cost. So adding the two, we have direct labor amounting to 1,900,000 pesos plus our manufacturing overhead total 725,000. So therefore, our conversion cost is amounting to 2,625,000 pesos. The next key area that I'm gonna be discussing right now, that would be cost classifications for external reporting purposes. Now, under this classification, there are two types. First, we have period cost, and second, we have product cost. Now, what's the difference between the two? We say period costs. These are the costs chargeable to the specific accounting period in order to match revenue. It is normally referred to as operating expenses. Examples of period cost, we have selling expenses, and we also have administrative expenses. If we say selling expenses, These are the expenses of a sales department, such as commission, advertising, payroll-related activities, rental, utilities, freight out and delivery expenses, or transportation out, etc. These are also called the order getting and order filling expenses. On the other hand, if we see administrative expenses, these are the expenses of administering an office, such as taxes, salaries, rental, utilities, etc. And aside from period costs, we also have what we call product costs. And product costs are costs assignable to the product which become an expense when the product is sold. And when these products are not yet sold, the cost assigned to the product is considered as an asset. For example, product cost includes purchases of raw materials and its related accounts, such as freight in, purchase discounts, purchase returns, allowances, and payment of direct labor, and the incurrence of overhead expenses. And the next key area that I'm going to be highlighting right now, that would be cost classifications for predicting cost behavior. And there are three types of cost classifications used in predicting cost behavior. First, we have variable cost. Second, we have fixed cost. And finally, we have semi-variable cost. So in order for us to better understand each of them, let us discuss them one by one, starting with variable cost. Now, if we say variable cost, a variable cost has the following characteristics. First, variability of the total cost in proportion to the volume produced. And second, relatively constant on a per unit cost as the volume of products changes within a relevant range. And third characteristic, we have easily assignable to operating departments. And finally, controllable by operating supervisor. And examples of variable costs, we have supplies, fuel, lumber, and overtime charges. These are just some of the many examples under variable costs. On the other hand, if we say fixed cost, this cost has the following characteristics. First, these are fixed total costs within the relevant range. Second, decrease in per unit cost as volume increases. And finally, assignable to departments using allocation methods. And examples of fixed cost, we have salaries of factory executives, we have depreciation, we also have property taxes and patent amortization. And lastly, we have semi-variable costs. These are the costs that are fixed within the relevant range, but varies proportionately with output changes. For example, we have electricity, we have payroll of inspection team, factory office services, water, and telephone charges. And the next key area that we're going to be discussing today, that would be cost classifications for decision making. Under cost classifications for decision making, it is composed of 8 types. First, we have differential cost. Second, we have differential revenue. Third, we have opportunity cost. Fourth, we have sunk cost. Fifth, we have avoidable cost. Sixth, we have out-of-pocket cost. Seventh, we have historical cost. And finally, we have future cost. If we say differential cost, it is sometimes called as incremental cost. It also represents the difference in cost between any two alternatives. Now, in order for us to better comprehend this one, let us have an example. Okay, for example, if the cost of alternative A is 500,000 pesos per year, and the cost of alternative B is 400,000 pesos per year, the difference of 100,000 pesos is the differential cost, okay? Second, we have differential revenue. And if we say differential revenue, it represents the difference in revenues between any two alternatives. For example, if alternative A's revenue is 750,000 pesos and alternative B's revenue is 500,000 pesos, the difference of 250,000 pesos is our differential revenue. And next we have opportunity cost. If we say opportunity cost, it is the potential benefit that one gives up when one alternative is chosen over the other alternative. For example, assuming Kevin is earning 250 pesos as a student assistant in college. Now, Kevin's friend invited him to spend a vacation in Laguna on Saturday. He opted to go to Laguna with his friend. Now, the opportunity cost is 250 pesos because this is the cost that Kevin gave up for choosing to spend a vacation on Saturday in Laguna. And next, we have sunk cost. What is meant by sunk cost? If we say sunk cost, it is a cost that has already been incurred and cannot be changed anymore by any decision made now or in the future. For example, a person purchased car A for 500,000 pesos. He found out days later that he needs car B more than car A. Now, in this case, 500,000 pesos is his sunk cost because no amount of regret can relieve that person of his decision or any future decision that may avoid this cost. It is done already. He purchased already car A, and therefore 500,000 pesos is irrelevant to a decision in purchasing car B. And next we have avoidable cost. So what is meant by avoidable cost? If we say avoidable cost, it is a cost that can be avoided if a certain decision will be made. Meaning to say, it is an expense that will not be incurred if a particular activity is not performed. Avoidable costs refer primarily to variable costs that can be removed from a business operation. Unlike most fixed costs, which must be paid regardless of the activity level of a company. There are also instances in which fixed costs can be avoidable costs. To better understand this one, let us have an example. Okay, so like I said earlier, avoidable costs are expenses that can be eliminated if a decision is made to alter the course of a project or business. For example, a manufacturer with many product lines can drop one of the lines, thereby taking away associated expenses such as labor and materials. Corporations looking for methods to reduce or eliminate expenses often analyze avoidable costs associated with underperforming or non-profitable product lines. Fixed costs such as overhead are generally not preventable because they must be incurred whether a company sells 1 unit or 1,000 units. However, if a specific business line utilizes a factory to make goods and that business line is discontinued, then the factory can then stop being rented or can be sold. Now, in reality, variable costs are not entirely avoidable in a short time frame. This is because the company may still be under contract with workers for direct labor or with a supplier for direct materials. When these agreements expire, the company will be free to drop the costs. Okay, so the next one we have out-of-pocket costs. If we say out-of-pocket costs, It is an expenditure that will be incurred as a consequence of a management decision which involves cash. Now remember, depreciation is not an out-of-pocket cost because it does not involve any cash outlay. For financial accounting purposes, these expenses are reimbursable from the client's company. Examples of out-of-pocket costs, we have salaries, we have advertising, and other operating expenses. Next, we have historical costs. And if we say historical cost, it represents the actual payment of the items purchased by the company. For example, when a company purchases a computer for 30,000 pesos, that is the amount paid to the supplier. Then this is our historical cost. Remember, this is one of our accounting concepts and principles. So whatever is the actual price, then that will be the one that you will be entering into the transaction or into the book rather. And finally, we have feature cost. If we say feature cost, this is the cost that is expected to incur. For example, Milano Company is contemplating to purchase an office computer amounting to 30,000 pesos for its new sales office in Baclaran. The 30,000 pesos is an example of a feature cost. All right, I think that's a good place to stop. If you have questions, please let me know in the comment section below. And if you like this video, please don't forget to subscribe and hit the bell button for the latest updates. Thank you. And finally, last,